Welcome back to Fast Market here on the Schwab Network. It's time for our cash tag segment. For that, let's bring in Landon Swan. He's a co-founder at LikeFolio. Welcome back to the show, Landon.
It's great to be here.
All right, so we're talking travel stocks. We've seen the airlines over the last several months here, Landon, under pressure, even though TSA numbers are great. Hotels did great throughout 2022. Marriott and Hilton or Hyatt taking hits today after their earnings. It seems like everybody wants to travel and everybody is, but if you look at like a lot of the stock charts, it doesn't seem like it's a very good environment for the stocks anyway.
No, I agree completely. All the data points really look good. I mean, except for maybe the airlines, they've got increased capacity, which of course means the prices are down, and investors never like that. But yeah, all the data that we have is showing a pretty strong evolving travel demand. In fact, some of the trends are more towards shorter trips, more urban trips, as opposed to the traditional, ski and sun type trips. But overall, we are seeing pretty good demand in travel. But you're right, the stocks don't really reflect that. So when we dive into the data and take a look at, Expedia, for example, and just see, are people talking more about, using Expedia, going to the website, all of that, we can see that the mentions are up about 18% on a year-over-year basis, which is good. People are talking about using the services, and they've got a lot of different websites. But it's pretty steady here, right? I mean, it definitely doesn't match what the stock has done. It's been very steady. The stock has been a lot more volatile and down as of late. I do want to contrast this, though, with Booking, who is up about 46% on a mentions level year-over-year basis. So they're doing a lot better than Expedia. On happiness, kind of the same story. Expedia's right around 61%, Booking at 69%. So they're beating them there as well. And 61 is okay for travel. 69 is pretty good for travel. When it comes to change in web visits, you can see here the Expedia is down just slightly on a year-over-year basis, about 3%. And of course, this is an important metric because you got to go to their website or use their app in order to book. I mean, that's how they drive business. And so this is very telling. And you can see the contrast here between Booking and Expedia at -3 and +5. So we do like Booking a little bit better than Expedia here. In fact, we've been bullish on it since we issued an alert about 11 months ago, up about 40% on that alert on Booking. We haven't done the same with Expedia. I would say that overall, between the two, clearly we like Booking more, but Expedia has taken some steps in their strategic planning that are very positive. So they've got the ability to integrate AI, and that's always kind of pleasing to the ears of investors. They're working on a conversational trip planning service, which I think is going to be very useful for people. Instead of having to click and read, you can just type and talk and tell the thing what you want. So depending on how successful or how useful it is, it could be big for the company. They've also launched their One Key loyalty program. They've got a significant increase in their B2B, which is up about 32% year over year. And they've got some smart partnerships coming in with MasterCard and Walmart, where you can actually use your loyalty points from those companies to book trips or book travel with Expedia. So they're making smart decisions. I think that the stock, I don't know if sell-off is the right word, but the recent decline in the price is maybe not warranted, and maybe it's a little bit oversold. However, if I'm picking a travel sector company or travel company, again, I'd lead more towards Booking than Expedia right now.
Hey, Landon. So, Tom mentioned that, hotels look pretty good. You look at Avis's numbers this morning, and they said demand's really strong, and they expect it to continue heading into the quarter. And if I was an investor looking for basically a leading indicator, I overlaid basically the airline sector onto Expedia. It tractor beams it pretty darn well, which tells you it's just the primary driver. And so if that were a leading indicator, I'm noticing that the sector is basically trading at the same levels it was back in last October when the S&P bottomed out. And so we've heard some softness in the terms of from Southwest and from Alaska in terms of potential demand there. And the charts are just selling off as if there's definitely going to be some kind of problems there. Do you see anything in terms of leading indicators if we look at the airline mentions and then we look at Expedia mentions? Is there something that leads in terms of either the happiness or the number of mentions that rolls over that might suggest that travel demand is waning?
Yeah, I tell you what, it all kind of goes together, I think, to your point. So we've got broad travel mentions that are not specific to airlines. We've got airline specific mentions, hotels, rental cars. We've got it all, and I think that the key is that we're seeing travel demand is holding steady, but it's shifting. Like I said, it's actually kind of moving into these shorter stays, which I guess if you want to think about it, shorter stays are going to be less economic activity for everyone involved. So while people are about the same as far as quantity of travel, we're actually seeing shorter duration. So that could be a negative leading indicator for the sector as a group, yes.
Yeah, and Landon, when I look at this, I look at like the hotels and the airlines are down significantly. They hold assets, right? They hold planes, they hold buildings, they hold real estate, and I think maybe that's part of the drag here. This is an asset-light model. They've got Verbo, they've got Orbitz, Travelocity. Is that one of the caveats that might help them in earnings, is that they don't own any of the assets, but, travel demand is still there and people still use these products?
Yeah, that's a two-way street. So yes, I mean they've got no assets that they have, all the liability, depreciation, all that, and concerns with. But at the same time, technology moves very quickly, and if they don't innovate and adapt, someone else will. And so it can very quickly shift to where they are completely, in general, websites. I'm talking about in general, not necessarily Expedia, but website can be, put to the wayside very quickly. I mean, just rewind and think about all the search engines before Google, right? I mean, Yahoo used to be #1, and then you can list 10 or 15 that most people have never heard of anymore. So that can happen to a website. So, hard assets don't go away as easily as the potential traffic on a website. So they have to innovate. But the caveat there is everything that I'm seeing from their management team is that they are innovating. So I'm very, very bullish as far as the direction of the company. I think that they know what they're doing. They're handling their business very well. They're setting themselves up for future success. I'm not worried in the immediate that someone's going to come in and just completely take over, but that is the other side to being completely digital, is you have to constantly be fending off these smaller competitors who are trying really innovative things to just take a bite out of your business. So Expedia is always a target. Booking's always a target. They've got to be careful, but they are defending very well.
Yeah, and they're scooping up companies left and right. I mean, they own Hotels.com, Travelocity, and others in this space. So, hey, if you can't beat them, you just scoop them up, and that's what I think they've done. This stock's pulled back from about 122 pre-earnings last quarter, now down to about $94, Landon. What kind of score do you guys have as far as earnings goes?
We're basically neutral. We're sitting at about a +6 on Expedia. On Booking, we're closer to, I think, a +18 or +19, so a little bit more. Not hammering the table on either one. Definitely like them long term. If they would sell off a little bit on earnings, I think it's a good opportunity to pick up shares. I would not be surprised if they're flat or just slightly down after earnings. I don't think they're going to blow up after earnings. I don't think they're going to go up tremendously. But long term, I do like this company, like both of them. But I don't see a giant move coming out of this earnings report.
All right, great stuff. Great data as always, Landon. Appreciate it.
Thanks, guys.
All right, that's Landon Swan, co-founder at LikeFolio. Nathan, I looked at a strategy here for an example, kind